Good morning, ladies and gentlemen, and thank you, Sergio, for your nice words of introduction. It is my pleasure to be here in Romania, and unfortunately, I cannot start my presentation in Romanian because if I were to do that, I think the Romanians would not understand me. So I hope that my English will be better understandable to you. The date which you see on that slide is not the date that the year that I was born, but it is referring to the founding year of the Catholic University of Leuven, which was founded in 1425. I wanted to talk to you in the 20 minutes that I have been received for this presentation about Solvency II, past, present, and future. I've learned as an academic that it is sometimes good to go back to the past and to see where we come from before we start to talk about the future. And on the agenda you see that I will cover that. I'll talk a little bit about experience that we have had with Solvency II, then the changes in the air, very important. Are we on the right track? And then last but not least, and that's of course the thing that you will be waiting for is to hear the truth about Solvency II. But let's start about the past. Well, the past of Solvency II is, of course, Solvency I. And Solvency I can be characterized by all those who are familiar with that as boring. I can tell you, ladies and gentlemen, that when I was, as a lawyer, first asked to deal with insurance regulation, and I looked at what was on the table, I said, how can possibly people be excited about something like that? That is Solvency I. Solvency I was a tick-the-box exercise. Insurance supervision, insurance regulation was highly prescriptive and paternalistic, and it was not very different in supervision. Supervision was a tick-the-box exercise. Very rarely insurance supervisors engaged with the industry. They were sitting in their offices, looking at papers that the industry had to provide them at regular intervals, hoping that the supervisor would read the papers, and then that's the way it happened. Then came Solvency II, the birth of Solvency II. When it was planned at the end of last century, 1999, a slow start because not considered a first priority. Often in financial services, the first priority will be banking and not insurance. It was conceived in 2004. Those of us who have been involved in conception of a child know that the moment of conception is the most agreeable one. Then it was a healthy pregnancy between 2004 and 2007. The delivery happened in 2009. Without too many complications, but then there was a postnatal depression, and there was the financial crisis. A very difficult situation for Solvency II. The child became severely ill between 2011 and 2013, and it was in intensive care with EIOPA 2013 and 2014, but then with an extra dose of vitamins, Omnibus 2, it is now alive and kicking as of the 1st January 2016. Now let's move to the present. What has been the impact of Solvency II on the insurance sector? The introduction of Solvency II went very smoothly, notwithstanding pressure from the low interest rate environment. Actually, the laboratory that Solvency II faced when it was entering into effect was the worst that could possibly have been designed. A low interest rate environment, financial crisis, that is not the ideal environment for a new system to start. But no company failed as a result of Solvency II. Some life companies went into runoff. Yes, we have seen insurance failures, but they were not due to Solvency II. Virtually all insurance undertakings have an SCR ratio, as I will show in a minute, which is well above 100%. The stress test, the latest conducted by EIOPA, also showed that under severe climate-related shocks, NatCat scenarios, the industry did very well. And why did the industry do so well? And it's very important that we keep that in mind, is the crucial role that reinsurance plays in the insurance market today. Many insurers have changed their business models. Some are moving away from offering long-term guarantees because that is very difficult, as you know very well, in the present environment. But why has the impact been so positive? Well, one of the reasons is that Solvency II was overdue and was embraced with enthusiasm by the industry and by the supervisory community. It was thoroughly prepared. Risk management has considerably improved. And actually, if I compare the status of the insurance industry today with the situation before we started Solvency II, the level of professionalism in the industry has remarkably increased, and that I think we should all be very pleased with that. Of course, there have been some transitional measures that facilitated the entry into force of Solvency II, and that was also necessary. Has Solvency II delivered? Well, there's some economic theory that has set up some characteristics, and I list them on this slide. What are the sort of elements that need to be in place in order to evaluate whether a risk-based solvency regime is all right? And you have them on the list. I will not go through all of them, but what is important is that capital requirements are risk sensitive. This was one of the failures of Solvency I, that the capital requirements were not related to all the risks that an insurance undertaking faces. We operate with an economic balance sheet. The system must be flexible, and also very importantly, the last tick on this slide is proportionality. And I hear that Romania is now talking about mutuals in the insurance sector. I can tell you out of my personal experience, mutuals have a very important role to play in insurance, and I think that going forward it is very likely that the mutualization of insurance will be better received in the future, and things will go in the right direction. For mutuals, of course, we also need the proportionality principle. The role of prudential supervision is important. People in the insurance industry may sometimes wonder, why do I have a supervisor? Why do I have to do all this? It's not just to please the supervisor, ladies and gentlemen, but it has to do with the fact that the role of insurance is very crucial, and that in order to make it work, it's important that there is a good relationship between the industry and the supervisor. The assessment is basically that Solvency II has delivered, we can say that. There are some critical elements which I have listed here, which of course relate now to what I will talk about in a minute, that's the future. First of all, an insufficient recognition of the long-term business model. Insurance is very different from any other economic activity. And it is different because it relates to the future. Nobody in this room knows what's going to happen tomorrow. But we do conclude insurance contracts that sometimes have a lifetime of 70 years. Now, how can you possibly deal with these long-term liabilities? And Solvency II has not been perfect in this. And one of the key changes that we will see under the review of Solvency II is how we deal with these long-term contracts. How can we avoid that they are affected too much by the volatility of financial markets, particularly when interest rates are low? The system has become too complex and too detailed. Some people have said that there are well over 7,000 pages that cover Solvency II. Now, that is far too much. I've always told people from industry that came to me and they asked, well, Karel, you believe in a principle-based regime, but what does it mean? I said, don't ask me the question, because I'll give you the answer and you get a rule. And then people from industry said, we love rules. We love the rules because then we can tell the supervisor, that's the rule, don't impose anything else on me. And the supervisors, they came to me and they said, Karel, we love rules. Because if we have the rule, then we can, the industry, you have to do this. If I don't have the rule, I cannot convince them that they have to apply it. So both of them, industry and supervisors, work to have more and more rules. And I tell you, ladies and gentlemen, I tell that to the supervisors, I tell that to the industry. The more rules you create, the less likely it is that you will apply them, because it's not possible to do that. And we should not all spend our time just applying the rules. We should always keep in mind what are the principles. And that's important. Proportionality. Another thing, everybody agrees the system should take account of the nature, the complexity, the size of the business. But then I ask the people, what does it mean in practice? And then they say, oh, we don't know. Supervisors will say, proportionality, I'll be very careful because I want everybody to apply the rules. I tell you, no. Look at the principles. Look at reality and not at theory. It's important that we give that a little bit more flesh to the bone. Governance. Everybody in Europe, all the member states of the European Union loved rules on governance. Governance is fantastic. Every day in the world there is a conference on corporate governance. Anywhere, everywhere in the world it is. People just love it. And look at all the rules that our member states have created in terms of governance. It's too much. It's not good. Too much focus on capital. We have two capital requirements under Solvency II. We have a minimum capital requirement and a solvency capital requirement. Many people today, both in the industry and in the supervisory community, will consider the SCR as the MCR. That was not meant to be like that. The SCR should be 100% and not 5,000%. That is not the way the regulation was designed. So we need to think about that. And finally, sometimes people still live in a Solvency I world and like the rules to tell them everything they need to do so that they don't have to use their brains in applying the system. So, very quickly, some experiences with Solvency II, the capital requirements. The standard formula, nobody is excited about it, but people are broadly satisfied. There is a challenge with the valuation of long-term liabilities. This is very complex. And I tell you a secret, ladies and gentlemen. There is no perfect way to value long-term liabilities. There is no perfect way. Economic theory will not give you the final answer there. That means that the solutions we develop will change over time again when we become smarter and we learn more about things. Actuarial involvement may be a little bit too much in the design of the standard formula. Actuaries are very important. You know the difference between an actuary and God. God knows that he is not an actuary. So keep that in mind. Pillar 1, yes. Well, you see the long-term guarantee measures. These measures were developed to help the industry cope with the volatile environment resulting from low interest rates. You see, out of the about 3,000 companies that apply Solvency II, only 700 apply the long-term guarantee measures. Of course, they are important companies, but it shows you also a little bit the relativity of that debate. SCR, how many companies were in breach of the SCR? These are the latest figures from EIOPA. Out of about 3,000, 25. Great. SCR ratio, average in the European Economic Area, 243%. Highest in Germany, lowest in Latvia. And look at Romania. That's not too bad. You guys are doing well. 172. You know, the rule is 100%. Be happy. MCR, again, total you see 650% in the European Economic Area. The lowest, again, Latvia, the highest, Germany. And Romania, that's not too bad, you know. Be happy. The standard formula is used by most insurers and reinsurers. Only few, as you can see here from the list, are using internal models. That's an area which will expand. The better you are in risk management, the more likely it is that you will develop maybe a partial internal model and a full internal model. And your supervisor will be happy. Supervisors are happy to look at internal models. I'm not sure whether you have any in Romania, but this is really challenging because it really helps you to better understand the insurance industry. Governance, just very briefly, is very important. Risk management is key in insurance, and it is starting with the risk culture, with the tone from the top. The problems we've seen in the insurance industry all relate to bad risk management. And if the top doesn't breed this risk culture, how can you expect the bottom in the firm to do that? Proportionality, own risk and solvency assessment. I mentioned already the overshooting in regulation that is not so good. ORSA is very important, and I'm sure the supervisor here in Romania will look at your ORSA reports. Draft them carefully. It's a good exercise for the company to know where the risks are and what can be done about it. Public disclosure, very extensive, heavily criticized sometimes by the industry. We should be happy. It's the first time in European history that we have detailed data on the insurance industry. It was not possible. Before Solvency II, any question on insurance could not be answered because the local supervisors didn't have the answers, nor did EIOPA have them. Now we have them. We can give you very detailed answers. And we should use this reporting to make that also work in the benefit of the industry. The solvency and financial condition reports, very important. Again, sometimes in industry people pay just lip service to drafting this report. This is the way, the SFCR is the way in which you communicate with the outside world. Do it right. The better you do it, the better you will be seen in the market. Group supervision is difficult. It's difficult because of, you see that on the slide here, the tick. In a group, all supervisors are equal, but some are more equal than others. It's very difficult for people to accept that one of them can be the group supervisor, can be the leader of the group. And to make people work together creates legal, cultural, psychological, linguistic problems. And that's why group supervision is important. You have groups here in Romania, local groups, but mostly you are also having subsidiaries of foreign groups. Well, it's very important that you, as a supervisor in Romania, take that into account, that this local operation is part of a group, which may have a lot of consequences. Group supervision has been looked at by EIOPA. In 2017, a first assessment. The Commission responded to that by saying, well, we're going to postpone all this until we have the 2020 review. The second assessment was made in 2018. Very interesting report that I would recommend you to read. Very interesting assessment by EIOPA on some of the weaknesses, particularly in freedom of services and freedom of establishment. What was the assessment by the Commission? The Commission didn't do anything. Changes in the air. The first change will be becoming law next month. It's the change of the delegated regulation of Solvency II. You see here the process. What does it deal with? These are some of the changes. Reduction of capital charges for unrated debt, unlisted equity. Some more further changes you can see also on this slide. The amendments of the delegated regulation, they go obviously in the right direction. The industry was unhappy that the risk margin has not been reduced. People feel that that is too high, but that will be part of the 2020 review. Very important is this last tick on the slide. That is that the review of Solvency II delegated regulation led to the creation of a new category of investments, which are called long-term equity investments, which benefit from a lower capital charge. And this is a reflection a little bit of this concept of the more long-term vision of insurance. I come back to that in a minute. This is a more fundamental review that is starting now. The Commission has asked EIOPA to look into a number of issues which are listed on this slide. Some are technical, some are more of a broader perspective, like macroprudential issues, systemic risk management plan, recovery and resolution, possibly introduction of insurance guarantee schemes in those member states that don't have it, and very importantly, proportionality and the treatment of long-term investments. The question is, how can we better reflect in insurance the long-term nature of the business? I refer to that, and this may operate through the concept of illiquid liabilities. EIOPA is looking at that. What is the timing? It's good to keep that in mind. It's not going to be for tomorrow. We have elections coming up for the European Parliament next Sunday, which means that there will be a new Parliament, there will be a new Commission. That means that there will not be a proposal for a review of the Framework Directive on Solvency II before sometime in 2021. Then we need the negotiations, give them a year, which would be quick. That would be 2022, then transposition by member states, 2 years. So basically, these changes will be unlikely to come into effect before sometime in 2025, which is important because it means that the present regime will be stable for a while, whilst we're thinking about the future. Other amendments of Solvency II, these are like the little trains that are going a little bit faster. The first one is a work on sustainability. EIOPA has given advice to the Commission for amendments to the delegated regulation to bring into the delegated regulation this concept of sustainability. Now, this is I regard this as very important. The future will be yours to the extent that you will give more recognition to sustainability. We need to get out of our short-termist approach in life, in business, and that's what it is about. Also, EIOPA is getting a little bit more powers in terms of cross-border business as part of the review of the system of financial supervision. Sustainable finance, that's important. Climate change, we talked about all the possible catastrophic things that might happen also in this part of Europe. We need to be prepared for these things. So sustainable finance is going to be very important, and this move away from short-termism is extremely important. We attach too much importance to short-term developments also in financial markets. Most of these developments in financial markets, ladies and gentlemen, are caused by people that want to make money out of it. They create a story so that the markets go up or down, and then they have the commissions on the changes. So we need to move away from that and have a more long-term perspective. Are we on the right track? I don't think we need to design Solvency III, so the reform that is taking place now is not going to create a complete overhaul of the rules. The system is not perfect, was never meant to be. It is designed as a flexible regime that should once in a while be looked at. Many reviews are foreseen, and we need to ensure that we find an approach which is sensible and realistic. Early lessons, difficulty to work with a principle-based approach. Insurers are developing strategies to optimize capital, which is fine. Risk management has improved. Insurance regulation is taken more seriously, also by the bankers, which is nice. And we have also the role of the supervisory colleges. Now, some important aspects of Solvency II is the responsibility of each individual undertaking. So it's not the supervisor that runs the business, it's you that run your business. More focus is needed on risk management and governance. And now, the truth. How do we learn the truth about Solvency II? There's only one way. This way. It's a book. It's a book that I've published that will come out in June next month, and it will tell you the truth about Solvency II. It's only 750 pages, so that it's the full truth, and it is available, and you have You can subscribe to it. You have a leaflet on the table. So if you want to know the truth, is only one way to do that. So ladies and gentlemen, with these words, I want to finish my presentation.